Insurance begins with risk, not fear, not paperwork, and not only monthly payments. Risk means the chance that something uncertain could cause a financial loss. A car crash, house fire, medical bill, lawsuit, theft, or storm may never happen, but if it does, the cost can be too large to handle alone. An insurance company looks at risk before it agrees to cover someone. It asks what could go wrong, how likely it is, how expensive it could be, and whether the risk fits the policy. The premium is not random. It is connected to the INSERA estimate of possible future claims. There are two parts to most risk: frequency and severity. Frequency means how often losses happen. Severity means how expensive they are when they happen. A cracked phone screen may be frequent but not financially devastating. A house fire may be rare but extremely severe. Insurance works best for losses that are uncertain, measurable, and large enough to matter. If a cost is guaranteed, it is not really risk in the insurance sense. If every homeowner knew their roof would fail next month, the insurer could not treat that as an uncertain event. A simple auto example helps. A careful driver may still face a crash caused by weather, another driver, or a moment of distraction. The risk is uncertain, but the repair bill, injury claim, or legal cost could be serious. Insurance turns that unpredictable possibility into a planned premium. Risk is not the same for everyone. A home near a flood zone, a driver with repeated accidents, a business storing flammable materials, or a person seeking high medical coverage may present different risks. The insurer studies those differences because they affect how likely and how costly claims may be. Underwriting is the process of evaluating risk before coverage is offered. The company may ask questions, inspect property, check records, review age or location, or require documents. Underwriting decides whether to cover the risk, what to charge, what limits apply, and what exclusions are needed. Risk pooling is what makes insurance possible. Many people pay premiums into a shared pool. Most will not have a major loss in the same period. The money collected from many policyholders helps pay covered losses for the few who do. The pool works only if risks are priced carefully. Some risks are predictable enough to price. Others are hard to insure. If a risk is too likely, too large, too concentrated, or impossible to measure, the insurer may exclude it or charge a high premium. That is why some disasters, business losses, or intentional acts may not be covered. Moral hazard is another part of insurance risk. It means people may act less carefully when they know insurance exists. A person might leave a bicycle unlocked if they believe theft is covered. Deductibles, exclusions, and claim rules exist partly to keep policyholders involved in preventing losses. Deductibles change risk sharing. If a policy has a deductible, the customer pays the first part of a covered loss. This reduces small claims and gives the policyholder a reason to avoid preventable damage. A higher deductible usually lowers premium, but increases the cost paid after a claim. Policy limits also shape risk. A limit is the maximum the insurer will pay for a covered claim. If the loss is larger than the limit, the policyholder may still owe the rest. A low limit can make coverage cheaper, but it leaves more risk with the customer. Exclusions define risks the insurer is not accepting. A home policy may exclude certain floods. A health policy may limit certain services. A business policy may exclude intentional damage. Exclusions are not fine print decorations. They are the boundaries of the risk transfer. Risk can also change over time. A safe neighborhood may face rising storm exposure. A driver may add a teenage driver to the policy. A business may expand into a new service. When the risk changes, the premium, terms, or available coverage may change too. This is why insurers ask for accurate information. If a person hides a home business, misstates vehicle use, or fails to mention previous damage, the insurer may price the risk incorrectly. Later, That can lead to claim problems, cancellation, or accusations of misrepresentation. From the customer side, the main question is not, what is the cheapest premium? The better question is, what risk am I keeping, and what risk am I transferring? A cheap policy may leave out the very loss that would hurt most. A family buying home insurance should think about the losses they could not easily absorb. Replacing a small appliance may be manageable. Rebuilding after a fire may not be. Insurance is most useful when it protects against losses that would seriously damage savings, income, or stability. Risk is also why two people can pay different prices for similar coverage. Their location, claims history, property condition, vehicle use, age of building, or coverage choices may differ. Insurance pricing is not only about what was paid last year. It is about what the company expects could happen next. Understanding risk helps you read a policy more clearly. Premium is the price of transferring risk. Deductible is the part you keep first. Limit is the maximum transfer. Exclusion is the risk the insurer refuses. Claims are the moment the risk becomes real. Insurance risk is the foundation under the whole system. Once you see that, insurance stops looking like a mysterious bill. It becomes a structured agreement about uncertain losses. Which ones are shared, which ones are priced, which ones are excluded, and which ones remain your responsibility. Insurers also separate pure risk from speculative risk. Pure risk involves the chance of loss without a matching chance of gain, like a fire or theft. Speculative risk includes possible profit, such as investing in a business. Insurance usually focuses on pure risks because they fit the promise of protection against loss. Loss prevention can reduce risk before a claim happens. Smoke alarms, safe driving, security locks, health screenings, and workplace safety rules all lower the chance or size of a loss. Insurance transfers financial risk, but it does not remove the value of preventing damage in the first place. This is why an insurer may offer discounts for protective behavior. A home with monitored alarms, a driver with a clean record, or a business with safety training may cost less to insure. The discount is not a reward for being nice, it reflects a lower expected claim risk. A person reviewing coverage should also think about timing. Some risks are seasonal, some grow with age, and some appear only after a life change, such as buying a home, hiring staff, or adding a new driver. Risk is not frozen on the day the policy is bought. The final lesson is that risk is the language insurance speaks. When you understand likelihood, severity, deductibles, limits, exclusions, and prevention, you can judge coverage more intelligently. You are no longer only asking, how much is the premium? You are asking, what loss could this policy actually absorb for me? That is also why choosing insurance should begin with your worst affordable loss. If a loss would be irritating but manageable, you may keep more of that risk. If it would threaten your savings, income, home, or business, transferring more of it may be worth the premium.